And so our agenda for chapter 5 says we're going to cover this thing called the adjusting process. Okay, we're going to take a little notch up on the level of difficulty now. So we've covered probably the first third of our chapters, and we've really hit hard the analyzing process of accounting. We've really hit hard the journalizing and posting process of accounting. We've practiced a few times with the trial balance in a previous chapter. So that brings us to the next part of the accounting cycle, which is recording adjustments. So we're going to talk about what adjustments are in just a second. I want to give you guys a second to pull those handouts and see if you have any questions while I kind of get my book over here organized as well. Okay, then what is the adjustment process? Okay, adjustments, probably most of this is going to be on our chapter 5 handout. So on the handouts, I always try and take a look backwards and then look forward. So on the chapter 5 handout, it reminds you where we've been. We've analyzed transactions. We did that in the first couple chapters. We've journalized transactions in a journal. We've created an economic diary for a company that keeps an economic history of what's happened chronologically. But the problem with that journal is it didn't keep balances. And so we learned about this second book called The Ledger, and we went through a tedious, boring posting process to get the transactions from the journal to the ledger. We had numbers going every which way when we did that. And so the last step we covered was we created a trial balance. And that trial balance was a document that's used for one thing. It's used to prove the equality of debits and credits. So now looking forward, here's where we're going. And by the way, these are steps in the accounting cycle. That first slide that I showed you on that PowerPoint, we're now going to gather adjustments. We'll talk about what an adjustment is momentarily. And we're going to prepare this thing called a worksheet. And this chapter intimidates a lot of students because, and I asked you guys to read it or at least scan it before class. It intimidates a lot of students because it's 10 columns long. And some students are just like, oh my gosh, I can't even get something with 2 columns to balance. How in the world does she think I can get something with 10 columns to balance? Well, I'm going to walk you through it step by step. That's the reason we come to lecture. We're going to demonstrate it. We're going to do a whole worksheet. If we don't finish one today, we'll definitely finish next time. And then after the worksheet, you guys already know how to do financial statements. So I want to just put the scariness, I guess I would call it, or the intimidation factor aside by telling you that this worksheet is just going to be horizontal math. There's no reason to be intimidated by it. I'm going to walk you through it. And the second part of this chapter, which deals with financial statements, you already know. You've covered financial statements. We've covered financial statements in 2 chapters already. So it's just going to be a repeat of what we've already done. And then chapter 6 is all we have left in the accounting cycle for a service-oriented firm. That'll be what chapter 6 covers. So this chapter is on these things called adjustments. So if I go look at that agenda again, this is what we're covering. What are adjustments? What are the characteristics of AJEs? This is an abbreviation you want to get into your notes. AJE stands for Adjusting Journal Entries. So we're going to be talking about 3 adjusting journal entries today. And then to make the math go a little bit easier, we're going to introduce you to this thing called a worksheet. It's an internal document. That means it stays inside the company, and it's used to pull together the adjustments and to give the owner a preview of what his or her financial statements might look like. So the start off to this chapter is understanding what an adjustment is. So before I go and jump farther into that handout, does anybody have any questions? All right. Some of you have asked me about this already, and you were astute enough students to understand or ask questions on why certain things were done in the previous chapters, specifically with respect to supplies. Had a lot of questions on that. So let's read. Adjustments are needed because certain accounts in the trial balance do not contain accurate balances. Okay, here's the questions that a few of you asked me way back in chapter 2, I think it was. A couple of you said, we keep debiting the supplies account. Every time we buy supplies, we keep debiting this supplies account, which you said was an asset. And my answer was yes, that's what we're supposed to do. And some very astute students said, well, what happens when we use up our assets, right? Our supplies don't sit around in a supply cabinet forever. Eventually they get used up. And so what happens at the end of the period is we need to make certain adjustments because we know certain accounts are not up to date. So the first one they're going to give you is the supplies adjustment. Before we go into that actual adjustment, let me cover a little bit more on these handouts on what adjustments are. Adjustments are internal transactions, things that we need to do inside the company because we know certain accounts are not up to date. The reason they're called internal transactions is because there are no outside source documents. In other words, we don't get an invoice or we don't get a check in the mail that tells us we need to do this. We just know as logical people that some of the accounts in that trial balance are not up to date. And that's because some assets get used up and some assets eventually expire. In every single one of these 3 adjustments that we're going to be doing right now, we're going to be debiting an expense. So if you got a highlighter, we're going to be debiting an expense and we're going to be crediting an asset, a balance sheet account. So that means that all of these adjustments will have a direct impact on the financial statements. Okay, so I want to make sure we get a few things down in our notes. Let me go grab some of these scribble notes that we were doing before. In fact, let me get a new sheet. And let's just get a few notes down here about adjustments. I'm going to increase my font so you guys can see it. Adjustments done at the end of a period. They always affect an income statement account and a balance sheet account. The reason that's important, because each one of these adjustments affect an income statement account and a balance sheet account. If you mess it up, all 3 financial statements are wrong. Let me put some bullets on here so these are a little bit easier to read. So they're done at the end of a period. They always affect an income statement account and a balance sheet account. And the effect is, if you mess it up, if you want me to talk like a professor, if you make a computational miscalculation, okay, I prefer to talk like a student. If you mess it up, all 3 financial statements are wrong. This is why adjustments are important. Okay, so a couple of points. They're done at the end of the period. They always affect an income statement account and a balance sheet account. In this case, for our purposes in this chapter, they're going to affect an expense and an asset. If you mess it up, all 3 financial statements are wrong. So the author is going to introduce you to 3 adjustments. We're going to be doing 3. So in your notes, the first adjustment is going to be for supplies. The second one is going to be for the prepaids. And the third one is going to be for depreciation, a word that you may have heard, but you may not understand what it means from an accounting standpoint. So the focus of chapter 5 is on adjusting journal entries. That was another thing I wanted to get into your notes. I said it, but I want to get it into your notes. AJEs means adjusting journal entries. And I know some of you might be handwriting this, and I know some people have said, wow, you type really fast. That's why we're so blessed to have Giselle in here. Not only is she able to help you guys with your homework, but she's also keeping very good notes, and she posts them in the discussion area if you ever need to go back and augment your notes. All right. So I'm going to go back to that handout, knowing that if you're still writing these down, again, Giselle's going to post these later, so you'll have access to them. Going back to this handout, let's talk about these 3 adjustments. A couple of you have brought this up. The supplies adjustments. We just keep debiting the heck out of this supplies account. So I'm just going to get my chapter 5, and I'm going to go to the end of Excel just so I can have in Excel something to scribble on. So the way you open a new tab in Excel is at the very end of the tabs, you'll see this little plus sign. So I'm going to go open a new worksheet, and I'm going to call it Scribbles. If you double click on it, you can give it any name you want. I'm just going to call mine Scribbles. I'm going to make this font much bigger so you guys can all see it. And all I want to do is get a T account up here. In fact, I'm probably going to handwrite it because it's just much faster for me. So here's what we've been doing. We know that supplies is an asset. We know that all asset accounts look like this. And every time we've been going to Office Max or Staples or Walmart and buying supplies, we've been debiting the heck out of this account. So I'm just going to make up some numbers. Let's say that during the quarter or during the month, I've made 3 purchases, one for 100, one for 200, and one for 50. Okay, well, if I do nothing, my trial balance is going to reflect that there's $350 of supplies. But we know this, our supplies don't stay in the cabinet, they get used up. And so an adjustment is needed to figure out how much has been used up. So I'm going to put that in here. Our first adjusting journal entry equals the supplies used up. We need to figure out how much doesn't have value to it anymore. Remember, the definition of an asset is property or things of value. So here's what happens. Companies take a very quick inventory. And when I say quick, I don't mean I do not spend 5 hours inventorying my supply cabinet. I'll go in there and say, I have a couple pads of paper, and I have a couple of USB drives, and I have some boxes of pencils. It looks like I have about $75 of supplies on hand. So I count my supply cabinet, cost it out, and I find that on hand, I still have $75 in there. What we need to figure out is how much has been used up. Okay, how do you do that? Let's foot this T account. When I foot this T account, it looks like I have 350, I'll call that subtotal, $350 in my T account, and I should have $75 in my T account because that's the value of the supplies that I have on hand. So on your calculator, when you take the difference, I'll use Excel to do it, the difference between 350 and 75, when you pop that in, that's going to tell you the amount of supplies used up. So go ahead and do that on your calculator. See if you get 275. That's what I got. So we have to do an adjusting entry to take it out of that asset and put it into supplies expense, a brand new account that keeps track of the cost of supplies used up. Remember the definition of an expense. An expense is an expired cost. It's a cost needed to support the revenues. So that supplies is going to come out of the asset and it's going to go into supplies expense. How do you do that? You do it through an adjusting journal entry. So here's the first adjustment. We're going to be using some type of an expense account, in this case, office supplies expense. and we're going to credit the asset called supplies or office supplies, whichever account name this company uses. For how much? For the amount used up, which we just determined was $275. And so that would record the supplies used up. How did we get it? We took the amount in the GL, the general ledger. GL is a very common abbreviation for the general ledger. We took the amount in the general ledger less the amount on hand, or the amount in inventory. That gave us the amount of supplies used up. Okay, let me stop and see if you have any questions about that first adjustment called supplies. Okay, so again, these are internal transactions that we're doing inside of our company because we know that certain accounts are not up to date. One of them is supplies. The second one, the second adjustment, unless you guys have questions, is going to be a prepaid. Any questions on the supplies? You can just unmute yourself, or you can type in the chat room if you can't speak. Okay, the second one is a prepaid adjustment. So again, a lot of you have come into my office and you are very astute, and you said, well, what happens when these insurance policies are used up? Okay, so let's assume, and I'll use this example because it is very practical to me. Excuse me 1 second. I have a service person here and I need to let my husband know that he's here. Excuse me 1 second. Okay, this happened to me with my oldest, or with my son. So about 12/1, I paid 12 months of his insurance. Okay, so for demonstration purposes, on December 1st, I paid $1,200 for a 12-month insurance policy. Okay, well, an asset is something of value. What happens at the end of the period, and let's use 12/31 to make it easy, is that prepaid account doesn't have 12 months of value anymore. Why? Because 1 month has now been used up, right? If I were to call my insurance company up in January 1st, and say, hey, my son went into the Marines, I want a rebate on my insurance policy because the car is not going to be being driven, they wouldn't give me back all $1,200 because there's some value to that. They would give me back $1,100. Why? 1 month of that, if I called on the early January, 1 month would have been used up. So when we make this adjustment, what we are asking ourselves is the same question we asked ourselves on the office supplies. How much has been used up? So if we're using a calendar year, December 31st, and again, back to Ulysses' question, to keep Excel from throwing that into a formula format, hit the space bar before you type in the date. If we're using an end of the month date of December 31st, 1 month has been used up. How do I know 1 month has been used up? From 12/1 to 12/31 is gone. And so the adjustment, just like it was on the supplies account, the adjustment is going to be to take it out of the asset and throw it into an expense. What kind of expense? Well, in this case, since we're talking about prepaid insurance, this would be insurance expense. How much? 1/12 has been used up. So on your calculator, if you take 1,200 times 1/12, you will get $100. $100 of that no longer has value to it. So we're going to take it out of the asset and put it into the expense account. So that journal entry just like we did up here on all of these adjustments, it's going to be a debit to an expense, insurance expense, and a credit to an asset, prepaid insurance. For how much? 100 no longer has value to it. $100 or 1/12 of that amount needs to be transferred out. So this would be to record expired insurance. And the way I got that, 1,200 in the prepaid times 1/12 used up. Back to those notes. All adjusting entries contain an income statement account and a balance sheet account. If we don't do this adjustment correctly, all three financial statements are going to be messed up. How come all three? Well, this insurance expense affects net income on the income statement. When you affect net income, capital is changed. And this balance sheet account called either supplies or prepaid insurance is also now going to be off. And so that's why these adjusting entries are of critical importance. So we've 2 out of the 3. This chapter has 3 adjustments in it. We just covered 2. Any questions on those 2? Okay, then the last one, going back to that handout, we'll go back and forth, is we've talked about the supplies adjustment. We talked about the prepaid adjustment. Let's go talk about depreciation. Okay, depreciation in accounting is not what the world views depreciation as. The world views depreciation as, usually in the example of a car, you've heard this, I know. As soon as you drive the car off the lot, it's lost value, it's depreciated. That's what the world thinks about depreciation. For accounting reasons, think about depreciation as a loss of usefulness. Okay, so here's what happens, and this is why it's important. Let's say that I have this, I'm just going to use 3,000 for a nice easy round number, this $3,000 computer in front of me. If I did nothing to record the expiration of cost of this computer, 10 years down the line, this computer is still going to be on my books at $3,000. Most of us would agree that the computer you used 10 years ago is worthless, right? Because technology changes so fast. So in order to have a proper matching of revenues with expenses, we need to depreciate this equipment. What the heck does that mean? It means that we need to take a portion each year and get it out of the asset and put it into the expense account. We do that through the depreciation process. So someplace in your notes, depreciation is a loss of usefulness. And again, if you want me to talk like a professor, here's the definition. Depreciation is the systematic allocation of an asset's cost over its life. Okay, in other words, an asset loses its usefulness. So an easy example, if this is a $3,000 computer, and I think that I'm going to use it over the next 3 years, which is pretty typical with computers, then I'm going to take 3,000 divided by 3, and I'm going to write that asset down, 1,000 in the first year, 1,000 in the second year, and 1,000 in the third year. And by the time I'm no longer using the computer, all of its assets costs will have expired on the income statement. That's the goal. Now, in life, there's probably 20 plus depreciation methods. I've had a class, if you think this class is boring, a class solely on depreciation methods is one of the most boring class I've ever taken. 20 different methods to depreciate assets. We're using one method in this class, and in next semester in 101, you'll use 3 or 4 different methods. The new version of the book, I haven't looked at it to see if they added a 4th one. So here's the formula. I'm going to go write it on our chicken scratching. Let's go back to our example here. So let's say we have a computer that costs $3,000, And Ulysses, I'll get your question in just a second. It has a salvage value of 300. And let's say that we're going to use our asset over 3 years. Okay, let me get those facts down. Ulysses, let me go ahead and answer your question. Go ahead.
Do we also consider the insurance cost of the computer?
The insurance depends on the insurance cost. If it's insured to get it to you, that would become part of the insurance cost. But the insurance, like on your property, the property insurance, that would be expensed. That would be expensed probably monthly as you pay it. It's a good question.
Okay, thank you.
Yep. All right. So what we're going to use is straight line depreciation. It is the most common. I believe a recent statistic that I looked at said that about 90% of companies use this. So it's very common. It is the easiest one. And the reason that it gets its name, straight line, is because if you were to chart the amount of expense, you'd literally see a flat line going out each year. Let's see what I mean by that. Straight line depreciation has a formula. Here it is. Cost minus the salvage value divided by the life. So here's the formula. I just made up those numbers that I put up here. Let's assume that this computer was $3,000. It had a salvage value of 300 and the life was 3 years. Well, this is what the formula would look like. We'd have 3,000 here. We'd have 300 here, and we'd have 3 years on the bottom. Okay, well, the top, the numerator here, that would be 2,700 divided by 3. When you do that on your calculator, you're going to get 900 per year. Okay, what does that mean? Every year you have that computer, you're going to transfer $1,900 out of the asset and into the expense. So the journal entry confuses some students, not the debit. The debit we know on all of these is going to be to some kind of an expense. So this is going to be to depreciation expense for the computer. That part makes sense to students. It's the credit that kind of freaks students out because most of us would say, well, just credit the computer, right? If you want the assets cost to go down, just go credit the computer. But for tax reasons, we cannot lose track of the computer's cost. And so we have this special account that we use to record accumulated depreciation, and that's its name, accumulated depreciation computer. Now let's talk about that account. Because remember from your last test, and I encouraged you guys to keep a running list of all these new accounts. From your last test, you'll remember that on every test, I ask you 3 things about certain accounts: the type, the normal balance, and what financial statement it's on. Right? So the type of this one is funky. I'm going to highlight it. I want you to pay particular attention to it. This is a Contra Asset account. We've learned about one other Contra account. We learned about a drawing account that was a Contra equity. This is our first Contra asset. Contra means contrary to the normal balance. And so the purpose of this is to pull the computer's costs down over the life of the computer. So what's going to happen now on a balance sheet, when you see a balance sheet from this day forward, and we'll get in more into that tomorrow, but while we're talking about it, this is what's going to show on the balance sheet for the computer. You're going to see the computer at its cost, I'll put cost up here, 3,000. And then directly below it on the balance sheet, you'll see this, less accumulated depreciation. And after 1 year, that would be 900. And then directly out to the right of this, you would see the value of that computer on the books now would be $2,100. This is what we call the book value. Okay, what does that mean? It means that computer costs us $3,000. We're not going to lose that asset for tax reasons. It's going to be sitting at $3,000. But right below it is telling the user that, hey, this asset has been used up for 1 year. Right now, that computer is $2,100. What's going to happen next year, see if you can follow this, is next year, I'm going to copy this down, your computer is still going to have a cost of $3,000, but next year it's going to have 2 years worth of depreciation. So what happens is that accumulated depreciation keeps going up, 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 and that book value keeps dropping each year. And as you learn to read these companies' financial statements, you can tell about how old their assets are by how much depreciation they've taken on their assets. As an investor, why do I care about that? Because when companies have really old assets on their books, it means they're going to have to come up with the money to replace those pretty soon. And they may not have money to pay stockholders dividends, things like that. And so again, we're in the nitty gritty in this class of recording journal entries. I also want you to think from bigger perspective, like that discussion post that you did last week. Think about this from a bigger perspective. Here's the question I ask myself when I'm in classes, and I will be in classes until I'm no longer a CPA. I ask the question, okay, what can I learn from this class to put to use for me financially? How can this help me financially? Well, I can start looking with a different set of eyes now at companies' financial statements and just zero in on how old their assets are getting. How can you tell that? By how much depreciation you see that they've taken on their assets. And then, by the way, since I'm going to finish this off, this would be the first year on the balance sheet. Here's the second year. Let me show you what this balance sheet would look like in the third year, just so you have a good picture of what depreciation does. In year 3, you'd still have this computer sitting there with a cost of $3,000, but now you would have 3 years of depreciation on it. You would have 900 times 3 would be 2,700. And now that computer is sitting on its books at its salvage value, right? Which is the amount that a company realistically expects they can get from selling or disposing of that computer. That's what this chapter is about. The hardest part is getting those adjusting journal entries down. After that, we'll look into how that worksheet, that 10-column thing, is used to pull together all this information so that the owner can get an overview of what's happened to his or her company. You guys must have questions after that. Okay. So,
I do have a question.
Yes, ma'am.
Okay, so I understand the first, second, and third year, but what happens after the fourth year? Are they gonna have to buy a new computer, or do they just keep using the same one and then just put like negative?
Really good question. Really good question. I think that was Maria that asked that.
Yes.
Yeah, it's a really good question. So what we estimate is at the end of the third year, it'll be time to replace that computer. So the company can go out and buy a new computer and then start depreciating it all over again. But Maria, you've probably had, and so have I've had the experience where, oh, I really don't need to get rid of my computer. I'm going to keep it for 1 more year. You wouldn't have negative depreciation. What might happen is you might decide to change that salvage value down, because if you use it another year, it's probably going to be worth less. And you'd have what we call a revision, and we'll cover that in next semester. But realistically, that's what can happen. And there are guidelines out there, right? Because Maria might use her computer for 4 years, and I use a lot of tax software, which needs high speed computing. I might only use mine for 2 years. So there is guidance out there on how many years are reasonable to use. So it's a really good question. It would be called a revision of estimate, and you'll cover it next year. So I'm going to write that word down based on Maria's question. Revision of estimate, covered in Accounting 101. And I know you guys have had this experience too, right? When I buy my car, I'm hoping that I can keep my car for at least 5 years, at least. And then if you haven't, it's just a matter of time. All of a sudden you think you're going to keep this car for 5 years and it turns out to be a piece of junk and you might have to replace it sooner. So that's another situation where we would revise our estimates. Any other questions? That was a really good question. All right, then I want to take a look, I think at exercise 5.1 to start us off. And then I hope to get to a worksheet. We'll see if we get to a worksheet or not today, or whether we wait till tomorrow. So exercise 5-1, this is the Excel spreadsheet from the modules link for chapter 5. We're going to take a look at this one just to get some practice with doing these journal entries. Make sure everybody has it up. And the first thing you want to be very careful of when you look at these exercises is what time period are they talking about? Some companies make these adjustments every month. Some companies make these adjustments at the end of every year when the accountants come in. So you want to make sure you have a good understanding of what kind of time period we're talking about. And so zeroing in on this question, this one says specifically end of June. So we're talking about 1 month's worth of activity here. So number 1 says on June 1st, a new firm paid $16,800 rent in advance for 7 months. The $16,800 was debited to the prepaid rent. Okay, well, a T account might help us. You don't have to do them, but they are good learning tools. So here's my prepaid rent. And what's sitting in there is $16,800. And they paid this on June 1st. And this was for 7 months. So the question on all of these adjustments is how much has been used up. And remember, they want these at the end of June. So when you're doing adjusting journal entries, you want to come into the journal like I'm going to do over here, and you want to write in the word adjusting. That tells the user that some adjusting entries are coming. Remember, adjusting entries are different from other entries. They're internal transactions that we make because we know certain accounts are not up to date. One of the accounts that will not be up to date are any prepaids. So this one's dealing with prepaid rent. So at June 30th, because that's when they told us to make these adjustments, at the end of June, let me make that column a little bit wider so that shows up, how much of that 16,800 has been used up? Okay, well, since it was for 7 months, 1 out of 7 months has been used up. So on your calculator, you can do 1 over 7 times 16,800. Go ahead and do that. Let's see if we get the same thing. 1 divided by 7 times 16,800. I got 2,400. Hopefully you guys did too. Giselle, you can check me on that and make sure you got 2,400.
Yeah, I also got 2,400.
Okay, thank you. All right, what do we do? Get back to what we just learned. Every single adjustment is going to be a debit to an expense and a credit to an asset. In this case, since this is prepaid rent, we're going to debit rent expense and we're going to credit the prepaid rent. For 2,400, I'll show you how I got that as part of my description. And the book will tell you that on adjusting entries, you don't have to write in descriptions, but I think of a journal as a historical document. I always write in descriptions to record the expiration of 1 out of 7 months of rent paid up front on June 1st. Okay, so the way that I got that computation was I took 1/7 times 16,800. Okay, again, I hope you got this in your notes because I've said it at least 5 times now. Every adjustment that we're learning in this chapter affects an expense and affects an asset. Another way of saying that, it affects an income statement account and a balance sheet account. So if we mess this up, all three financial statements are going to be wrong. That's why these are important. I've had a doctor cry in my presence. Giselle's already heard this story. I'll probably save the story till the next class session and recap it for you then. But this can have a big effect, especially with businesses that have a lot of assets. And what I'll tell you, I'm 56, right? The last time I checked, I believe it was, I have 12 different insurance policies, right? 12. The more assets you get, the more, and professional license and companies, right? The more assets you acquire, the more you have to protect them. So you can imagine how much a small to medium sized business spends on insurance. If an individual at 56 years old has that many insurance policies, this can be a huge adjustment. Okay, next one, supplies. I'm going to make this bigger so we can see it. You guys all have access to this, so even if you can't see mine, you can look at yours. It says on June 1st, a company bought supplies. Okay, again, I'm going to make a T account. Here's the supplies asset that we've been using. It says they bought supplies for $12,580. It was debited to the supplies account. Now, here's what you got to watch. This author is sneaky. He goes back and forth with his wording. He next says an inventory of supplies. Sometimes he'll tell you how much is used up. And sometimes he'll use those words, inventory of supplies, and make you figure out how much has been used up. Inventory means on hand. So I'm going to come out here and I'm going to write the words on hand, 9275. So that's how much should be in supplies. And again, what we're after is how much has been used up. So go ahead on your calculator and do the math. And I got 3305, and Giselle or someone else can speak up and let me know.
Yes, that's correct.
Okay, awesome. 3305. What are we going to do? The same thing we just did on the other adjustment. We're going to increase an expense and we're going to decrease the asset. So I'm going to go back over here to my journal and get that line out of there. Same date. So you don't have to write the date in, but if you want to, no problem. And since we're talking about supplies being used up, we're going to use supplies expense and the asset account called supplies for 3305. That was the amount that we just computed. And if you're wondering how we got that, I'm going to show you. To record supplies used up, I'm going to put in account, and let me go back and recreate what my T account said, 12,580. And on hand, there was 9275. So used up would be the difference. Put a little line in there to show taking the difference. That's how we came up with it. These are internal transactions that a company makes because they know certain accounts are not up to date. We know that any prepaid is not up to date because some of it's going to be used up. We know that our office supplies don't just hang out in a cabinet not getting used. We need to record the usage. And the last one's probably going to be a depreciation entry when I go back over there. But any questions on the first two? All right, then let's do this last one. It says on June 1st, the firm bought equipment for $108,000. That's the cost. It has a life of 9 years. That's the life, and no salvage value. Okay, well, GAAP says that assets don't have unlimited lives. They get used up. And so to record the usage of an asset, we learned that we use this method called straight line depreciation. It is the easiest out of the 20 or so methods that exist. We learned the formula looks like this: cost minus salvage value divided by the life. And they just gave us the parameters that we need. So on the top, I have my 108,000. My salvage value was 0. And my life was 9 years. So go ahead and pop that into your calculator. What you're left with is 108,000 divided by 9. So be careful. This is my annual depreciation, right? Remember our time period. We're not doing this for 1 year. We're doing this for 1 month. So what we need to be careful of is that we only take 1/12 of that. This is for 1 month. So 1/12 of 12,000 is going to be 1,000. Or the other way to do this, your book may do it this way, so I want to show you both ways, is to record the life in months, right? So the top is still 108,000. But the life would be, what is 9 times 12? I can't do that in my head. 9 times 12 is 108 months. Whichever you prefer, you can get a monthly depreciation rate either way. You can see that's also 1,000. So we need to record that 1 month's worth of depreciation. Before I record that, does anybody have any questions on the math there? All right, then this is the one you're most likely to miss because it has that funky credit, right? I know that for all these, I'm using an expense. So most people don't have a problem getting that depreciation expense. That's usually not where the problem lies. The problem lies in the credit. The credit is to that funky contra account that we learned about called accumulated depreciation on the equipment. And I'm going to write down to record 1 month of depreciation using straight line. And since I just showed you the calculation, I won't bother showing it to you again. Any questions on those 3 adjustments? That's the first half of chapter 5. Okay. If not, no questions. And if you do have a question, please speak up. You guys are filled with great questions. All right, then I want to show you, just introduce you to this 10-column worksheet that's going to be intimidating because, again, we're used to dealing with 2 columns, and especially if you haven't done your chapter 4 homework yet, you're just struggling with getting 2 columns to balance. Don't let this intimidate you. You guys have Giselle and you have me and you have Zoom sessions. I'm here before class. Giselle's in her Zoom before class. Giselle's on her Zoom couple hours tomorrow night, and Giselle's going to be on her Zoom during the test, during regular hours on test day as well. So there's plenty of help out there. So don't be intimidated when you see this. Let's open up exercise 5-3, and this will be our first attempt at this thing called a worksheet. And if you haven't read the chapter yet, it might be even more intimidating. But we're going to work through it step by step. That's why I'm here. That's why Giselle's here. We're going to work through it. Okay, so let's make sure that we found exercise 5-3. And then right next to it in the next tab is the worksheet, right? So I'm going to read it first, and then we'll go hit that worksheet that's on exercise on the tab right next to it. And hang in there. I know it's a long time to sit and listen, but these compressed summer classes, we really don't have too much time to waste. Okay, it says on January 31st, the general ledger of Jones & Company showed the following account balances. And here's what they want you to do. Prepare the worksheet through the adjusted trial balance section. Assume that every account has a normal debit or credit balance. This is important. The worksheet covers the month of January. So again, we're talking about 1 month. And they give us these accounts. And then they give us the information we're going to need to make the adjustments. So right before class started, I kind of snipped this adjustment information and pulled it over to here so I wouldn't be going back and forth. So this is a 10-column worksheet. It's a little bit intimidating because we're still getting used to working with 2 columns. So let's talk about what this worksheet is. It's a tool used to pull together all of the data for a company, and we're going to drop in the adjustments, those 3 transactions that we just learned about. We're going to drop in similar transactions, and then we're going to do this 10-column worksheet that's going to give the owner a preview of what his or her financial statements look like, even before we do formal financial statements. It's internal. That means it doesn't leave our desk. We don't send this out to the bank. We don't send it to our creditors. We don't send it to the IRS. It's a tool where we're going to gather together all the adjustment data and give the owner a preview of what's coming. So what I did to start us off is I took those balances from this problem, these balances, and I dropped them into the trial balance worksheet. So the first reason I want you to not be intimidated is this is the same trial balance that you've been using now for several chapters. There's nothing new about it. It's simply a list of the accounts with the proper balance dropped into the account columns. What chapter 5 did, this is the new part, is it introduced us to 3 adjustments. So what we're going to do is we're going to use this internal tool to gather together this adjustment data that was listed at the bottom of the previous tab. We're going to drop the adjustments in, and then we're going to do some horizontal math to get an updated picture of what our data looks like after these 3 adjustments are dropped in. So that's where we're headed. Any questions before we jump in and we try those 3 adjustments? Okay, here it goes. So letter A says supplies used. See what I mean about the author going back and forth between the wording? This time he just told us how much has been used up. There's nothing to calculate. He gave it to us. So go find the supplies line item. I'm going to highlight it so you guys focus on it. And what he told us is we've used up 5,700 in supplies. So I'm going to drop a little letter A in there. And then I'm going to go and put in the 5,700 that was used up. When a company uses up their assets, the asset is credited and some kind of an expense is debited. So what kind of an expense should we use? Supplies expense. 5,700. Drop it in. So we did 2 things. We identified the accounts. We know that all 3 of these adjustments affect an expense account and an asset account. So we debited supplies expense and we credited supplies. We're not doing the formal journal entry yet. So right now our goal is to complete this worksheet to the best of our ability, knowing that it's an internal tool that's useful for gathering together all the data and presenting an owner an overview with what's happened. So any questions on letter A? All right, letter B, expired insurance. We didn't have to figure out anything. He just told us the amount. So pick the insurance, the prepaid insurance. I'm going to put it on a different color so your eyes are on it. I see that there's a spelling mistake there. Probably should just ignore it, but let me fix it. Insurance. Okay, they said that the insurance used up was $2,050. So let me put my little letter B in the skinny column, and my balance that was used up in the bigger column. This is insurance that's been used up. So the appropriate expense category would be insurance expense. So there's my matching debit and credit. I'm using colors to help you see it. And then they even told us how much the depreciation expense was. They didn't make us do the straight line calculation. They just said depreciation for the month was $1,850. Okay, we know we're going to debit an expense. So I'm going to go to depreciation expense and put that $1,850 in. Let me highlight that to get your eyes on it. I'll make it orange. And the offset was a funky contra account, meaning that it's contrary to the normal balance of an account. It's accumulated depreciation. You'll see it right below the related asset account on a chart of accounts. So it's right below equipment. And it was for $1,850. So what the heck did we just do? We are learning about this worksheet. We're learning about how it helps us gather together all the data to give the owner a preview. Step one was we started off with the same trial balance that we've been using for several chapters now. I dropped those numbers in for you in the interest of time. We footed it. We know what balances. This is the new step. We just dropped in the 3 adjustments that we just learned about. We dropped them into their proper categories. Now, before we go any further, we're going to foot the accounts. We're going to foot this worksheet. And this is where Excel can really save you time. So once I put in one formula here, I'm going to copy that formula all the way across so that it will automatically update. So how do you do that in Excel? Ulysses looks like he was wanting to learn how to use Excel. So equals sum. I'm going to just do it fairly slow. Open the parentheses. The way you do that, it's above the number 9. And then highlight it from the top to the bottom. Make sure you start at the top and make sure you go to the bottom. And once you've done that, press the enter key. I got 9,600. So if you miss that, I'll do it one more time. Equals SUM, sum. Open the parentheses and highlight from the top to the bottom or the bottom to the top, whichever you prefer. And press enter. And then once you have that in there, we can use this little fill handle in the right-hand corner. That's called a fill handle. You'll see that in the middle of the cell, it's a fat cross. When I move my cursor to the right-hand corner, it turns into a little skinny cross. Grab your mouse, hold it down, and take it off to the right, all the way across. And what that will do for us is every time we put numbers in this worksheet, it'll automatically total it for us, which is much better than having to go back to this calculator every single time. Okay, our debits equal our credits. So now we're ready for the next step. So step 1, fill in the trial balance. Make sure it foots. We did it. Step 2, drop in the adjustments. Make sure it foots. Ours foots, the debits balance out to the credits. Step 3, get this adjusted trial balance. So this area right here is what we're interested, this blue area, in filling in next. Okay, it's horizontal math. We're simply going to take a look at each one of these line items. I didn't count the lines. It looks like there's maybe 15 lines. And we're going to do the math across to provide updated information to the owner. So cash did not change. Bring it over. It's still $63,000. And accounts receivable did not change. Bring it over. Now I want to wait for a second, wait for you guys to catch up, because the next 2 line items did change. These are assets, And these assets were credited, which means they were brought down. So on this one, we're going to take 9,000 minus 5,700, either on your calculator or Excel. And that means we're left with supplies of 3,300. How did I get that? 9,000 minus 5,700. And for prepaid insurance, we started off with 8,200 and we used up 2,050. So now we have 6,150. The cost of the asset didn't change. It's still 91,500. Okay, now is where we really have to pay attention because we got a funky contra account and we've never used a contra asset yet. So contra asset means contrary to the normal balance. They had 0 in it. They had a credit of 1,850. So I got to move over here to the credit column. I now have 1,850 sitting in the credit column for that contra asset. Accounts payable didn't change, just bring it over. It's a credit balance. Capital didn't change, just bring it over. Fees income didn't change, bring it over. And that brings us down to our expenses. So let me stop for a second. Any questions on the blue adjusted trial balance? We're about half done. All right, a lot of these expenses change, so be careful. We want to look line item by line item. Depreciation started off with 0 and we increased it to 1,850. We know that all expenses have debit balances. Insurance expense started at 0 and went up by 2,050. The rent didn't change. I'm just going to carry it over. I don't know if you guys noticed that each time we put a total in, if you carried the totals over, they're being automatically adjusted. Great thing about Excel. And salaries expense is 10,850. It didn't change. And supplies expense started at 0 and went up by 5,700. I'm done with the blue area, and I'm really happy to see that my debits equaled my credits. That would be my next challenge. The last step, the very last step, we're almost done. We have this internal tool. We now have new numbers in our adjusted trial balance. The last step is to drop these numbers into either the income statement or the balance sheet, but never both. Now you notice we don't have a statement of owner's equity column. That's to keep the number of columns down. So here's how I want you to think about that. The only thing that goes on the income statement are revenues and expenses. Everything else by default is going to go on the balance sheet. So I'm going to use color to make this happen. I'm going to put these revenues and expenses in pink, just so it shows up better. And everything there, let me find a pink color. Just something. Close enough. Everything in that area is going to go here. And everything else by default, if it's not a revenue or expense, by default, it's going to go on the balance sheet. So I'll leave that blue. So I don't know if you guys are too tired to finish this up. I think what I'll do is I will take the extra 5 minutes to finish this up. And then maybe we'll cover this at the start of the next class in case anyone's just like, mentally I've had it. I got to tune out. That's okay. I get it. But let me go ahead and finish this out. The revenues and expenses are going to be carried over. So in Excel, you can carry them over by typing an equal sign and clicking on it if you want. or you can just type it in. Let me show you what I mean. If you're not an Excel user, watch. I'm going to press my equals button right here. And then I can go click what number I want to pull over. And if you don't want to do that, you can type it in, but it's much faster. And for me, someone that is making transposition errors a lot because of a mild form of dyslexia, it keeps me from making transposition errors. If I hit equals and I can just grab it, and I hit equals and I can grab it. And if you know how to use Excel, you can even copy that, but I won't do that yet and confuse you more. Now, one thing I want you to notice, if these are our revenues and these are our expenses, we don't expect these to balance out. We're hoping, in this case it happened, that our revenues are much more than our expenses. So to finish this worksheet off, we're going to show the owner whether he made or lost money. So if these are his revenues and these are his expenses, net income is the difference. I'm going to take the difference between those two, and I'm going to show him that, look, I haven't finished up the financials yet, but you've made $85,950. And if I do this correctly, when I'm done, this same amount, if you read the chapter, this same amount has to balance out the balance sheet columns. In other words, when I finish dropping in these blue numbers, I better be off by exactly the same amount. So let's go see. Through the magic of Excel, it will do the math for us. I'm going to go use my equal sign and grab those blue numbers. You guys can do the same, or you can type them in. Equals, click, and equals. I'm just clicking the numbers where they're coming from. I'm going to pick up every blue number, and be careful when you get to the credits, to the Contra Assets and the liabilities and the other accounts. Ulysses, I think I saw that you had a question.
You could also use Command C, right? And then
Yes.
Command V.
Yep. You can copy and paste them. Yes, sir, you can. Now, what I wanted to show you is when I take the difference between these two numbers here, I better come up with the same amount. So let me do that real quick. I'm going to take the difference between those two. And it is identical. If it's not, then we made a math mistake someplace. So to finish this up, I'm just going to add my columns down. So there's 117,000 there. Those balance. I'm going to sum these up. They also balance. And when I sum these up, they better balance. That is a worksheet. It's an internal document used to pull together all of the data that a company has and to give the owner a preview of what his financial statements are going to look like even before we formally do them for him or her. So right now that owner is looking at a profit for 1 month of about 86,000. He or she's going to be pretty happy, I would think. And we're giving him a glimpse into what his balance sheet also is going to look like. This doesn't replace financial statements. This is a tool used to give an overview. And so I don't want this to intimidate you. The best way to get over intimidation is to practice, practice, practice. So what I would do if I were you is finish up the chapter 4 homework, anything that you may have left open. Maybe it was a problem on the errors because the errors can be challenging. And then start chapter 5, go try a worksheet. And when you guys come back tomorrow, we'll go try this other worksheet, probably 5-1B, and then we'll refresh our memories about how to do a set of financial statements. The good news is you guys know how to do the financial statements. The only thing that's really going to change is that presentation of the equipment, like I showed you earlier on that other exercise, because now we have that accumulated depreciation to deal with. So excellent job paying attention today. I know that that's a lot of numbers on your screens, and I know that some of you are writing out notes manually. So pretty soon, Giselle's very quick. Pretty soon she'll have what we used today posted in the discussion area. If you need to go look at hers or print her workout, that's one of the reasons that we're so blessed to have Giselle in the classroom. Questions on anything ahead, anything on the calendar, questions on the exam that's upcoming, anything?
How did you get the 85,950?
85,950. So over here, I took the difference between these revenues and expenses here on the income statement side. And then over here, I took the difference between those two columns. So my formula, Ulysses, if you're doing formulas, I took this cell, or sorry, this cell minus this cell. Here's my formula. L27 minus M27.
Okay, thank you.
Yes. Anybody else? Okay, thanks for paying attention. Thanks for the great questions. Giselle and I are both in our office an hour before class starts, so you can Zoom live with either of us. Either one of us will be happy for you to share your screen if you struggle. And both of us are happy to make other appointments if you can't make it to the early morning office hours. Just reach out and we'll make sure you get the help we need. After this week, you guys will be halfway done. I'm so proud of all of you that have hung in there. I did want to mention one other thing, and I was debating whether I was going to tell you this or not.